Everyone, welcome back. My name is Manis. I have a brother named Me, and together we make financial videos that are simple, beginner friendly, and they're just here to teach teens how to be smart with their money and be prepared for the future that's ahead of them. All right. So, we're gonna be talking about the financial X curve. It's a basic, simple concept about financial, like just how to save money better, and you just be able to understand things, and hopefully, it's a base to make better decisions later on. So I have a quick question. What happens to your family financially if you die too soon? I know it's sad, but it's reality. And what happens to you if you become disabled and can't work? What if like you sadly have something like a car accident, you lose mobility of your spine, you just can't sit down, you can't do basic jobs. So and like also on the brighter side, what happens to you if you live a long life into your 90s? Do you have enough money saved to not run out of money? Like on an average, we eat 4 to 5 times out weekly, and you have groceries, you have medical bills that which go up when you grow up. Do you have enough money saved up? And once you understand it, you'll never think about insurance and investing the same way again. So let's break it down. So you have two lines on a graph. The bottom axis is your age, 30 to, and it starts from the 30s and 40s, and to out to your other side, it's 70s to 80s, right? So just going young to older. So the first line is red, and that's your responsibility. It starts high when you're young and slopes downward as you age. The second line is green. That's your savings and wealth. It starts low when you're young and slopes upward as you age. Basically, what it's saying is when you're young, you have more responsibilities, and then when you're older, you have less responsibilities. And when you're young, you have less savings, and when you're older, you should have increased wealth. Again, if you do like live and save correctly. Okay. So, and then somewhere in the middle of life, those two lines cross, as you can see over there. This is why this is called the financial X curve. Okay. So why is responsibility so high when you're young? Just remember the acronym DIME. D is for debt, credit cards, personal loans, income, mortgage, education. Like, okay, so debts. We can start with credit cards, personal loans, car loans, just anything that you're purchasing, you need money for, obviously. And I for income. If something happens to you, that income needs to be replaced for your family. So sadly, again, if you become disabled, you need to have a source of income. And like, how can you be just prepared? Because if you're not able to earn, then you need to be like sustained, like just have enough money for the rest of your family. And then M is for mortgage. Most people haven't even paid off their home. Like 75% of Americans haven't paid off their home yet. So that's like a big expense that happens. And then education, either for your student loans, as a lot of American people take loans for their education. And then you also have your education for the future of your kids, private school, and then eventually college. And even if they want to extend their college to getting a major and like stuff like that. All of that stacks up early in life, which is exactly when most people have the least amount of money saved. That's the danger zone. And it's why we ask those three hard questions at the start. Die too soon, become disabled, or live too long. Each one hits differently depending on where you are on this curve. Okay, so then we have the will and trust. Right in the middle where the red and green lines cross, you'll notice something small but important, will and trust. This is the point where your responsibility and your wealth are roughly balanced, but it's also the reminder that no matter where you are on this curve, you need to plan for if something happens to you. A will and trust makes sure that whatever you built or whatever protection you have in place actually goes where you want it to go without the courts deciding it for you. Basically, say I've earned $1 million or $2 million until like maybe I'm 50 and sadly something happens to me and I'm just no longer here anymore. I pass away in a car accident or something. I want my money to go to my kids, to my family. I want my houses, my properties, my cars. I want everything to go where I want it to go. I don't want somebody else deciding it for me. So that's why we have a will and trust. And it's a really important thing that you want to even make sure your parents have. Okay, so now let's flip to the other side. As you age, ideally your responsibilities go down. Debt gets paid off, kids grow up, the mortgage shrinks, while your savings and wealth go up. But it's not just about having money saved on the side of the curve. That money can actually work for you in a bunch of ways. You have tax-free growth. You have tax-free retirement income, an emergency fund for the unexpected, covering your college education for your kids or grandkids, down market protection so a stock market crash doesn't wreck your retirement, tax-free legacy transfer, passing wealth to the next generation efficiently, and disability and long-term care coverage. Because living too long sometimes comes with health costs too. This is the whole point of the X curve. When you're young, you protect the downside. As you age, you build and protect the upside. So here's the takeaway. No matter your age, you're somewhere on this X curve right now. If you're young, your job is to protect your responsibilities, your income, your family, your debt. If you're older, your job is to build and protect your wealth. And remember, life is uncertain. You don't get to choose whether you die too soon, become disabled, or live a long life. Sorry about that. And if this helped make the X curve click for you, drop a comment where you think you are on this curve and subscribe because I'm going to keep breaking down concepts like this one video at a time. Again, this is a really simple concept. It should just be a base for your understanding as you grow up and like what are the smarter decisions you can do because there's a lot more that go in these curves, but this is just like it's something to think about when you're young and hopefully it helps you. Thank you. Have a good day. Yep.